Berkshire Hathaway just reported their third quarter earnings results, and they had this very interesting news development, effectively where Warren Buffett was making one of his largest purchases for the year, over $7 billion in this one stock, over $20 billion year to date. We'll talk about what stock he's been buying and otherwise a market that's not finding a lot of bargains, and also talk about Berkshire Hathaway's valuation and how Berkshire's A shares could be worth over $1 million in the next 5 years, potentially over $700 or around $700 for the B shares. We'll talk how to, think about those potential valuations in the years ahead. Those are, a hypothetical framework. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. Let's dive right in so that way you can understand. And first, in full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Berkshire Hathaway, even though when you look at those prices and these values that we're going to be talking about this video, maybe I should. And so diving in, so first, earlier today, Berkshire reported their third quarter 21 results, and the news publications like the Wall Street Journal reported how earnings fell 66%. What a joke. I mean, I personally think this reporting widely misses the mark. The reality is that their earnings were 66% lower only because their investment portfolio only gained $5 billion during the quarter versus $32 billion last year. And as a lot of folks remember, last year during the third quarter, you had this dramatic recovery from the COVID panic that resulted in a lot of stocks dropping. And then you had this massive intervention by the central banks. So that way stocks started shooting up during the third quarter last year. So not surprising that the investment portfolio didn't do as well during the third quarter this year. But even this is deceptive, calling out just this quarter, given that Berkshire's portfolio has increased by $38 billion year to date versus only $1.4 billion year to date last year. So when you look for the 9 months ended September last year, it only increased by $1.4 billion, whereas this year it's actually doing much better. So this type of one-sided reporting, with that type of headline figure about a 66% drop, just reflects, in my opinion, how Berkshire is sort of not loved right now and sort of out of favor with the market. You could see these are many of Berkshire's top holdings, with Apple being one of the largest, $120 billion valuation in terms of what Apple is relative to Berkshire's portfolio. And now the reality is that Berkshire reported very solid earnings, in my opinion. Excluding investment fluctuations, their operating business pre-tax earnings grew 5% from around $7 billion to $7.3 billion during the third quarter, and grew 18% year to date, so during the 9 months 2021, from around $20.3 billion to $24.1 billion. This considers all their operating segments. The only thing really worse during the quarter was underwriting losses, which jumped from around $400 million last year during the third quarter to around $700 million in response to Hurricane Ida and other natural disasters. Now, Berkshire's cash hoard continues to grow and now represents over $140 billion, given that they only need about $20 to $30 billion sort of as backup for super catastrophe insurance purposes. Think these mega catastrophes. And that is part of Berkshire Hathaway's special advantage, is that they can write catastrophic insurance that other players just can't do. And part of it's because they have this willingness to sit on $20 to $30 billion in cash. Holy smokes. But you back that out and look at their cash balances, and they have well over $100 billion in liquid buying power, a lot of dry powder. So that way, the next time there's any sort of market disturbance, if the Federal Reserve is not there to step up, Berkshire Hathaway is going to be in a great position with that $100 billion that they could put to work. So what's the security that he bought for around $7 billion plus during the most recent quarter, and over $20 billion that he's bought year to date? Once again, we're talking about Berkshire Hathaway. What is Warren Buffett buying? And the answer is he's buying more of himself. He's buying more Berkshire Hathaway stock. So he's been buying back stock to the tune of $7 billion during the third quarter, over $20 billion year to date. So this raised the question, is Berkshire cheap? Because if Warren Buffett sees a lot of value in it, does that potentially mean that there's an attractive risk reward for you as well? Let's do a quick plug to understand. If this is your first time tuning in, once again, you're watching Unrivaled Investing. Please make a point of hitting that subscribe button. And if you're interested in following along with my personal financial journey, go to unrivaledinvesting.com, where each month I call out potential multi-baggers as well as my personal portfolio. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So once again, if you're interested, go to unrivaledinvesting.com, click join the journey. And if you're enjoying videos like this, please make sure to hit that subscribe button. And so, to think about Berkshire, currently it's around $650 billion market cap. The diversified business operations, which mostly benefit from inflation, given that they have pricing power. So, See's Candy raised prices another 5-7% this year. They're going to be able to do that because they have these very powerful brands. So these businesses mostly benefit from insurance. They're up around 18% year to date. That's their operating businesses so far this year. Now, it's not always, great like this. Over a multi-year period, it might be, mid-single digits, 5, maybe 7% over time that you can get that growth. But still, these businesses, these operating businesses generate around $25 billion in after-tax earnings power. This includes Burlington Northern Santa Fe, this major railroad. But this doesn't give any credit to their massive float in cash hoard, which is around $500 billion in cash, treasury securities, equities, fixed income. And so if you assume this massive pool of capital can compound at around 5% after tax in the decade ahead, and maybe that's low, maybe that's high, depending on what you think, risk reward looks like for, let's say, Apple, which is a big component of that 500 billion. That's, that's around 150 billion of that 500 billion. That's, if you think they can do around 5% after tax on that 500 billion, that's another 25 billion annually. So you think of their cash and capital generating around 25 billion, and then you think about their operating businesses doing another 25 billion. This is both in after-tax figures. And so all in, you're thinking nearly $50 billion in annualized earnings power and around a $650 billion market cap. Now, that's a very undemanding valuation of 13 times. And once again, if you want to have a broader understanding for Berkshire, sort of a deeper dive, I previously did a video, sort of a recap of all their business segments, so you can check that out if you're interested. Meanwhile, he's using, Warren Buffett, he's looking at this significant earnings power, this significant, let's say, $50 billion in terms of earnings power, and he's going to use the free cash flow that's generated to buy back stock. And given that the stock currently trades at the equivalent of around 13 times, that's going to be the equivalent of around 7% plus per year. So assume, so when you think about 7% a year, because that's 1 divided by 13 is 7% plus. So that means if you just own stock and they don't grow at all and they just keep doing this each year, that means your ownership in the pie is going to be compounding at 7%. That's really interesting. That starts smelling interesting. When you start setting a sort of a hurdle of 7%, you start saying, well, wait a second, let's layer on some additional goodies like organic earnings growth and maybe some multiple expansion. You get maybe, 2.5 to 7.5% organic earnings growth over the next 5 years. And maybe you get a little bit of multiple expansion from 13 times to maybe 18 times, maybe 20 times. So if you start thinking about these things in the range that I'm penciling out, saying high of 18 times organic earnings growth of, let's say, 7.5% over the next 5 years, then you're penciling out upside of 140% in the next 5 years. This would imply about a $700 price for the Berkshire B stock and around $1 million, a little over $1 million for the A shares, which is just sort of mind-blowing when you think about a single stock trading for $1 million, the A shares, even assuming fairly conservative assumptions for their future growth and even multiple contraction. You're sort of penciling out a reasonable risk reward. Like in my low scenario where I assume this multiple contraction and let's say only 2.5% growth, I'm still penciling out a mid-single digit return, just given the fact that if you do have these headwinds like a multiple contraction, like effectively people saying, hey, this business is only worth 10 times versus 13 times, the reality is if you're buying back a significant amount of stock each year, that really helps you out a significant amount. And so looking at this, I'm thinking, wow, this, it's not crazy upside, like 300-400% upside, but from a risk reward perspective, it's really not bad in what I'd argue is a very frothy market. So, but once again, this is a hypothetical framework. Of course, stock prices can go way higher and way lower. This is sort of assuming, hey, if things work out, if operations succeed, if for some reason Berkshire Hathaway starts falling apart, let's say, there's dramatic problems in different subsidiaries and their business starts declining for some reason. First of all, there's no indication of that happening right now. But if you were to see something like that, then I would expect worse downside. And on the flip side, if their organic growth rate and you have a period of high inflation resulting in a higher organic growth rate because they can pass on this higher inflation to the customers because they have these powerful brands, that could mean maybe I'm even being conservative with that 140% upside. So that's something to think about here. I find it pretty interesting looking at Berkshire stock. It's not as cheap as the most recent potential multi-bagger that I called out for my Unrivaled Investing Journey subscribers. It's also, this exclusive company is also a company that has beaten the market indices for several decades, similar to Berkshire Hathaway beating the market indices for several decades. This other one, though, trades at 30% discount to book value. And so if I pencil out maybe just 5%, 10%, 15% compounding in the ensuing years, which is sort of management's goals, then you're looking at, instead of like 140% upside, which is sort of the high side that I'm penciling out for Berkshire, you're looking at, here in this situation, looking at something that maybe is closer to 250% upside. So something that strikes me as a little bit more interesting in this environment. But either way, looking at Berkshire, Warren Buffett buying back his own stock, clearly a vote of confidence saying, hey, I think this is cheap. I think it's definitely worthwhile to sort of scratch your chin, pop the eyebrow, think about it, and try to figure out, maybe Berkshire Hathaway is appropriate for my own personal investment journey. Definitely something to think about in what I'd argue is a very frothy environment. If this video has been helpful for you, think about Berkshire Hathaway and the latest $7 billion purchase by Warren Buffett. Please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching.